Now let's understand how to judge whether it is a good balance sheet or it is a weak balance sheet. Uh, it's good to know what the current assets are, what the current liabilities are, what the non-current assets are, what the non-current liabilities are, what the shareholders' funds are. But what is equally important is how do you figure it out? How do you figure it out whether it is a strong balance sheet or it is a weak balance sheet? And why is that question? And that question is because we all know by experience and otherwise as well that any balance sheet, every balance sheet anywhere in the world will always have the same total on the two sides of the balance sheet. That is, the total of the assets and the total of liabilities will always be the same. So if the total of the assets and the liabilities are same, then how do we come to a conclusion whether this is a good balance sheet or it is a bad balance sheet? So for that purpose, friends, we will need to look at three factors. Of course, there are many things that you can look at for figuring out whether it is a strong balance sheet or it is a weak balance sheet. But three things that you can focus and look at. One is the number of reserves and surplus. So bigger this number, stronger is the balance sheet supposed to be. So any balance sheet that has got the figure of reserves and surplus sizable, you can say that this is a good sign for a balance sheet. So that is number one. So any company which is doing good, the reserves and surplus figure will always be positive. A company which is not doing good, reserves and surplus figure will be negative. So that would really mean that the capital of the company also has eroded to the extent of the losses that the company has incurred in the past. So that's number one. Number two, what you look at is the debt equity ratio. And how do we calculate debt equity ratio? We will calculate the debt equity ratio by taking the debt in the numerator and equity in the denominator. And this is our debt equity ratio. Now this is one parameter, one KPI that is used to assess whether balance sheet of a company is strong or weak. Typically, this number, if you really ask me, is more useful to the lenders. So this debt equity ratio is more useful from the lender's perspective. So any lender who wishes to give loan to a company, he would always look at the debt equity ratio. So if the debt equity ratio of that entity, depending on whether it is a manufacturing company or it is an NBFC or it is an infrastructure company, the ratio would change. For a manufacturing company, typically a debt equity ratio of 2:1 is considered to be good. Anything above 2:1, the lenders will not be very comfortable in lending money to such an entity. So you can look at the debt equity ratio. We will also remember the debt equity ratio, and this is what all of you as the company's secretaries, as the legal professionals, as the professionals helping the boards of the companies need to also understand that the debt equity ratio doesn't have to be looked at in isolation. You should always look at the debt equity ratio in conjunction with EBITDA, and that I'm going to discuss with you little later. The second ratio that you can calculate to find out whether it is a good balance sheet or it is a bad balance sheet, and that is your current ratio. And how do you calculate the current ratio? Current assets divided by current liabilities is your current ratio. Now, this is another ratio that gives you an idea about how good or bad a balance sheet is. So these are the three factors that you can take into account for determining as to how is the balance sheet of this particular company, whether it is a good balance sheet or it is a bad balance sheet. We can take one question now. Once again, Shibam.